It didn't happen during the day. No traders yelling into microphones, no flashing alerts, no anchors pointing at charts. It happened when liquidity was thin, when attention was low, when resistance was weakest. And when the market reopened, silver looked normal. Too normal. Still trading, still liquid, still boring. But stuck. Pinned just below a number that has haunted the silver market for decades. $100. If you've watched markets long enough, you learn something uncomfortable. Prices don't stall at round numbers by accident. Round numbers are psychological. They're symbolic. They're where narratives break. And silver breaking $100 wouldn't just be a price move, it would be a signal failure. Because silver isn't just another commodity, it's money that refuses to behave like one. For years, silver has been treated like an afterthought, too small to matter, too volatile to trust, too old-fashioned to excite. But that's exactly why it's dangerous. Because silver doesn't rally when people are optimistic. It rallies when something underneath the system stops making sense. And right now, a lot of things don't. Inflation is cooling, but costs aren't. Debt is manageable, but growing faster than ever. Rates are restrictive, but governments keep borrowing anyway. None of this breaks the system immediately. What it does is stretch it. And stretched systems don't snap loudly at first. They creak. Silver is one of the few assets that creaks before it breaks. To understand why $100 matters, we need to step away from charts and talk about structure. Because silver isn't priced like oil, it's not priced like corn, and it's definitely not priced like stocks. Silver is priced like an insurance policy that most people forgot they bought. Most trading volume in silver doesn't involve silver at all. It involves contracts, paper promises, agreements that say, "I'll give you silver later." But later almost never comes. Instead, contracts are rolled, offset, settled in cash. This works because the system assumes one thing will always be true. Most people don't want the metal. They want exposure. As long as that assumption holds, price is stable. The moment it doesn't, price becomes irrelevant. Only availability matters. Here's the uncomfortable math. For every ounce of physical silver that can actually be delivered, there are multiple claims against it. Not 2, not 5, dozens. Depending on how you count derivatives, leases, and ETFs, the ratio can become extreme. This isn't unique to silver, but silver is uniquely fragile because it's consumed. Gold mostly sits, silver disappears. It's used in solar panels, medical equipment, electronics, industrial applications that don't care about price narratives. Which means inventories matter, and inventories are tighter than headlines suggest. Now let's talk about $100. $100 silver isn't scary because it's expensive. Adjusted for inflation, silver has been there before. What's scary is how it would get there. A gradual move is manageable. A sudden repricing is not. Because a fast move forces delivery questions. Who has metal? Who doesn't? Who promised too much? At that point, the market stops being about price discovery and becomes about credibility. That's why silver has always been treated differently during stress periods. History gives us clues. In 1980, silver surged rapidly, not because demand exploded organically, but because too many claims converged at once. When the system felt threatened, the rules changed. Margins were raised, buying was restricted, selling wasn't. Silver collapsed. The lesson wasn't that silver was dangerous. The lesson was that control mattered more than price. Since then, silver has been allowed to move, but never too freely. Spikes are discouraged. Momentum is capped. Not always with brute force, often with timing. Holiday sessions, overnight markets, low liquidity windows. These are moments when price can be nudged without attracting attention. That's what makes the idea of a midnight move plausible without being conspiratorial. If you wanted to stall momentum quietly, you wouldn't do it at noon. You'd do it when nobody's watching. Not to crash the price, just to drain energy, to exhaust buyers, to let boredom finish the job. And boredom is powerful, because most people don't panic when prices stall. They leave, which is exactly what stabilizes the system. But here's the irony. The more silver is suppressed, the more imbalanced the structure becomes. Because physical demand doesn't disappear, industrial usage doesn't pause, solar installations don't wait for better narratives. Silver keeps leaving the system, quietly, which means paper claims represent a shrinking pool of real metal. That's manageable until it isn't. $100 is the level where that imbalance becomes visible. At $30, silver is a trade. At $50, it's a hedge. At $100, it's a statement. It says inflation math failed. It says trust is eroding. It says paper promises might be overstretched. That's not something financial systems like advertising. So instead, they prefer silence, stalls, range-bound trading, nothing to see here. But silence doesn't mean stability. It means tension. And tension always resolves. The question isn't if silver moves, it's whether the system gets to manage how it moves. Because history suggests it rarely does. To understand what happens next, you need to understand how silver is controlled without looking controlled. It starts with futures markets. Futures exist to provide stability. They allow producers and consumers to hedge risk. In theory. In practice, they also allow price to be influenced far beyond physical supply. Because futures don't require metal up front. They require margin, and margin can be adjusted. When prices rise too quickly, margin requirements rise too. This forces weaker participants to exit. Selling pressure appears without anyone intentionally selling metal. Price stalls. This isn't manipulation in the cartoon sense, it's risk containment. But containment has side effects. Because when futures dominate price discovery, physical reality becomes secondary, until it doesn't. Now layer banks into this. Banks don't just trade silver, they intermediate it. They lease it, lend it, use it as collateral. Silver becomes part of balance sheets, which means price stability matters. A violent move higher creates mark-to-market stress. It exposes leverage, and leverage is the one thing modern systems are built on. Debt isn't the problem. Debt volatility is. That's why silver spikes are treated like emergencies, not because silver matters economically, but because it reveals instability psychologically. Silver rising sharply doesn't crash markets. It makes people ask questions. And questions are dangerous. Why is this moving? What does it know that we don't? Is something breaking? These questions spread faster than prices. So systems prefer slow, managed, predictable. But here's the paradox. The more you manage price, the more you distort signals. And distorted signals create blind spots. That's how crises form. Not from shocks, from ignored warnings. Silver has always been a warning asset. It moves before trust collapses, not after. That's why it's suppressed. Not forever, just enough. But suppression isn't free. It requires increasing paper supply, more contracts, more promises, which increases fragility. At some point, someone asks for delivery, and then another, and then another. This doesn't happen all at once. It trickles. But systems aren't designed for trickles turning into trends. They're designed for averages. That's why the Christmas trap matters. Holiday periods reduce liquidity. Price moves become exaggerated, and interventions become easier. A stall here buys time. Time to reset positions.